You know, Spencer, behavioral finance can be a lot like impulsive children. We think that we are rational in our decision-making abilities, but if you've ever watched a child, they can typically not make the best decisions when emotions are high. And so what we want to talk about today is behavioral finance and how to move away from that impulsive decision-making that we are often trapped by.
Today we get to talk emotions. And we talked about them in the intro there, that sometimes we have petulant children that make these decisions that are based on their emotions, and that behavioral finance can be a little bit like that. But we really want to normalize this, and that all of us go through this, and it's not something that we need to hide from, really. We are emotional human beings. Studies would show, so many different studies would show from the behavioral finance side of things, that if we have decisions that are really complex and that are really important, that our emotions get involved at a higher level. So not everybody makes poor decisions with respect to their investments when these circumstances arise, but we are more prone to it, all of us. And so we need that plan, and we'll be talking through some of these pieces. But today, we're going to talk about 9 different ways that we can kind of label when our emotions can get the best of us and the circumstances around that. So we're excited to dive in. We'll be able to share some anecdotes, not of any particular conversations that we've had, but there's a lot of general conversations that we see play out over and over again. And one of those that we'll start with is the herd mentality. So what's that?
Yeah, so when we think about the herd mentality, Sarah overhears her coworkers talking around the water cooler that there's this one stock that's really skyrocketed in the last couple weeks, and fearing that she has missed out, she impulsively invests in the stock without doing any research whatsoever. We would never hear about anything like this.
Well, when your barber starts giving you stock tips, which this has happened a few times, that the herd mentality may be kicking in for some people. And it's something that's difficult because you hear it from a couple of different sources and you start to say, okay, maybe I need to get on with all these other people.
Yeah. Well, and you think about it with the meme stocks, or sadly with a lot of cryptocurrencies, is people hear all of this conversation and it's really the early investors that get the most rewarded. If you're jumping in late, it's really inopportune. And so, I think about times in my life where I've jumped on a herd mentality, peer pressure to get in. It typically doesn't end well. So that's number 1. Number 2, confirmation bias. Talk us through that one, Spencer.
So let's just say we've got this guy, John, and he is bullish on a particular company. He's heard some friends talk about it. He's done some research. Confirmation bias is that idea that he's going to pay attention a lot more to the positive things about this company than the negative things about this company. So he's going to be highly sensitized to the people who are on financial media reports that are saying, okay, this company is a roaring buy. Got to move forward with it. You're going to be missing out on the greatest deal in the history of deals if you miss this one. You start getting inundated. I think Google is smart enough to start sending us emails, because they're reading our stuff. They'll start sending us emails from all kinds of different financial media that reinforce that. So we have this tendency psychologically, but then we even have sometimes social media that reinforce it, be it Facebook or Google or whoever that is reinforcing that. And that prevents John or us from looking at things more objectively, because we're not hearing the other side of things, which is, well, this could be a home run, but it could go to 0.
Yeah. Okay, so our next one is an overconfidence. So Emma has invested a couple times in companies that have done really well. And rather than think that the companies have done well, she thinks that she has made the right choice. And it produces in her this desire to continue picking stocks based on what she feels is she's good at, which happens sometimes. People can make a good decision and then a company can make a really strong run, but that doesn't mean that you are good at picking stocks. And what happens there is our overconfidence, the fact that we believe that we are good at something. It reinforces that narrative that I can do this well, and I don't have to do the due diligence and the research, but I can trust my gut.
Well, it can do that, or it can even put too much confidence in your capacity to do research. So every now and then we'll come across a situation where clients on a financial plan and they say, well, I'm just going to take a couple $1,000s over here. It's going to be my mad money and I'm going to invest. And we always smile and say, okay, well, good, that's fine. As long as we don't get too much confidence in that, because there have been a couple of times that we've seen folks, they make a purchase that turns out to be really good. But there maybe was only a couple minutes of research that was done here, or maybe there's not really a part of that with the plan. Well, the most dangerous thing that can happen is that $5,000 investment goes to $10,000, and then suddenly we have someone who thinks that he or she is just really good at this. So instead of it just being $5,000, it would have been better if that money had been lost or it didn't do very well because they could stick and adhere to the plan. What if they take the lump sum or the lion's share of their assets and then they start putting it into that strategy? So that's where the overconfidence can really start to bite us, is when we come up with these conclusions that aren't based on any kind of good thought process or long-term planning, because it can be a pretty nasty downturn then.
Right, and we want to pause here and say a lot of these can overlap. So if you have overconfidence and you have confirmation bias, then it can drive you to make even worse decisions.
Yeah.
If you are overconfident and you've had some runs of success, then you're biased towards believing that this one company is going to do well because you like their CEO, a lot of things can change, and a lot of things can change really fast. And so we want to say, before we jump in even further, is that beware not just of these particulars, but how the particulars interplay. We're complex humans, and so a lot of these things can build off one another. So, Spencer, explore a little bit more of loss aversion with this example of our buddy Mike.
Yeah, so Mike invests in a stock that quickly declines in value. And despite there being a potential for recovery, or it could be that Mike just invests in the stock market as a whole and the market goes down at the first quarter or first even year, or a couple of years. Instead of looking at it in a rational context of, okay, I know these things are going to go up and down, there's this attachment to that loss. There are plenty of studies that are out there that would show, roughly speaking, that we feel the losses about twice as much emotionally in terms of weight as we enjoy the gains. So this is not, this is not a good hard wiring in some ways. We really have to work against this, because history would suggest that stocks over time are going to grow and they're going to pay us if we stay the course, if we're diversified and we do other things, to be able to stack the odds in our favor, so to speak. But from a psychological standpoint, that loss aversion can mean that we see a downturn somewhere near the start of our experience and we say, I'm just not going to do that again. I'm never going to do that. I'm never going to make the same mistake. But we can be leaving significant opportunity on the table there.
Yeah. Okay, so the next one we're going to talk about is anchoring bias. So in anchoring, Lisa has purchased a stock at a high price. She got in maybe at the top of the bull run. Well, when the stock starts to lose its value, she's going to continue to hold on to it because she is anchored to that price that she bought it at. She's waiting for it to recover back to that price. And maybe there's not going to be a recovery, but she's holding to that fundamental value, but she's missing opportunities to reassess, is this company actually worth the price that I bought it for? Or did I enter at a wrong time? And it's kind of like what you were saying, going back to that loss aversion. We don't want to admit that we've made a mistake. Humans are hardwired to not want to make mistakes. And so if we've got that anchoring that, no, I believe that this is what this stock is worth, and then we also feel the loss, but we're anchored to what that is, we really need to start reassessing, is this what that stock is actually worth?
Well, and where this can be really dicey is if we have someone who's worked for a company for many, many years.
Yeah.
Let's just say they worked for a firm like GE in the glory days, and that stock has gotten crushed over a period of a decade or more. If there is a hope to see those resources go back up or that stock price go back up because the company is going to do well or whatever it might be, and you hold on to that, sometimes that can be a significant position. There can be a diversification need there to split those resources and to put them in the context of an overall plan. with one position, if it's a small position, sometimes that doesn't really bite us near as much. But if it becomes a large position in the context of our overall goals and our portfolio, that's where we really have to be careful about that anchoring bias and whether we need to just, get back in line with the plan, cut our losses, and get back in line with what's going to be most helpful long term.
Right. Well, and I think what's really interesting is you can watch some of these infographics that show what were the largest companies in the stock market over time and how often those actually change and move. So if you're anchored to say, well, it's telecom that really deserves to be at the top, or it's oil and gas, or it's IT, and you're anchoring towards even a sector, that can be dangerous as well because those companies move around based on the cycles of the economy. So walk us through this next one, the recency bias.
Well, this is where I would say we see a lot of our clients who come to us and we're walking through financial planning for the first time and they're still working and they have a 401k and they're allocating resources across investments in that 401k. We see this show up more times than not. So probably more than 50% of the folks that we sit down with, there's a recency bias. And what that basically means is we look back at the most recent results and we project and say, well, that's got to be the way that it's going to be for the future. So we might be in a period where value stocks have done really, really well. Well, we kind of find that more clients have kind of tilted over their portfolio with the recency bias to say, well, this has done well recently. Of course, I need to have more resources over here. The same thing on the growth side. Maybe we've been through a period like 2020 where the growth stocks did really, really well. We find in 2021, that more people, are over there having kind of lumped a bigger portion of their 401k into the growth stocks because they performed well in the rear view mirror the last, 1, 2, 3 years. We want to be really careful about that. We want to instead build a plan that's diversified across a lot of different investments and asset classes because oftentimes an asset class that's had its day in the sun is expensive. It's just done well. We may not want to overload there. We may want to diversify back to something else that's not done as well. So it all needs to be in context with the plan.
Okay, so the next one, FOMO.
Oh.
Fear of missing out. Turns out it doesn't just come with activities. It comes with investing as well.
Yeah.
FOMO, the fear of missing out. So think about this. We have someone that, again, they're sitting down with lunch with coworkers and she hears them talking about this new hot cryptocurrency. She fears that she has missed an opportunity to invest in something that could go to the moon, as cryptocurrency proponents will say. Well, cryptocurrency market shortly after that crashes.
Right.
If she invested at that peak, or if she got scammed because her coworkers were also not investors that really did their due diligence and research, and they got in at a bad time, or they got in to one of these crypto scams, it's not going to be good for them. This fear of missing out, fear of everybody else is doing it, I need to do it too, that peer pressure is really dangerous and can really lead to a tremendous loss of value.
Well, and it's one of those cycles too that we see on social media where it can just be self-reinforcing.
Yeah.
You get in one of these Reddit chat rooms and everybody's this is the consensus. Well, that's only a small part of the population that's really just focused on that particular thing and may not have any other perspective. So it can be dangerous there. The other side of that is, if we've got someone that maybe they've drunk the Kool-Aid of the financial media in a different way, or some stock market prophet, and they're trying to time the market. So let's just say we've got a guy, Jim, who is he has seen the historical performance of this particular strategy. Now, the caveat here that we always have to come back to is there's a lot of different historical performance, that's out there. And I put it in air quotes because there are a lot of firms that will publish this strategy, but they didn't have it in play over the last 20 years. They just did back testing on it, just meaning that they had the computer look at it and say, okay, if we ran one of these 8 different strategies, what would have been the best way if we chose, to do things? And it can be something as inane as we're going to invest on Monday and sell on Tuesday, or we're going to invest in, January and sell in July. is there value to that? I guess some people could, posit that there is. But those market timing pieces, because there's not really a plan in place other than I'm just going to listen to this person's signal or sell when they say sell or buy when they say buy, it's very hard to develop a level of confidence or a consistency with that. And so oftentimes people will do that for a season until it doesn't work, and then they're out, and then they feel burned. So we have to be very careful about that market timing type of strategy in this example.
Yeah. So the last one we're going to touch on is the gambler's fallacy. And Alex believes that after a series of losses, she is due for a winning investment. She's picked the wrong one over and over and over again. It's time to roll the dice one more time. It's got to work this time. Well, it's just a fallacy. That's not how investing works.
Right.
And you really need to if you're taking those larger risks, thinking that the next big one is right around the corner, you probably shouldn't be taking bigger and bigger risks with the assumption that a win is going to come.
Well, and even our verbiage there trips us up, because so many people that we'll sit down with will say at some point in time, well, I just kind of feel like this is gambling. At the end of the day, we want to shift this from it being numbers that are called the stock market to owning actual companies.
Yeah.
Because most folks would say, okay, well, I don't know what the prospects of Walmart are, next year, but I don't think it's going to go out of business. So it's not like we're putting $10,000 on red, and just hoping that it works out well. Gambling is something that is very, very different than investing, where you actually own a company. And hopefully you diversify enough that maybe you own thousands of different companies, such that if Walmart doesn't do as well, maybe it's because Costco is crushing them. And maybe you own both of those companies so that you're not putting too much of your portfolio in any one particular stock.
So Spencer, we've walked through 9 of these behavioral finance biases. What are maybe some ways that we can safeguard against those pitfalls?
Well, we've talked about it. We develop a plan, and we think through all the different pieces of that plan. We also really grapple in the midst of that plan with how much risk are we willing to take on? We joke that there's some clients that sit down with us and they say, I'm not buying green bananas from the grocery store. So, their time horizon is very, very short. So we want to be much more conservative, obviously, with those folks. We have other folks that say, I have a career here ahead of me that's probably going to be 40 years. So surely stocks, I'll hope and believe that they'll do better than bonds over a 40-year period. So we've got a range of different time horizons to a plan, and we've got a lot of different preferences with respect to risk that we really need to incorporate into the plan. But if we do that, then we give ourselves a much, much better chance when the stock market goes down of saying, well, we knew that was going to happen. If the stock market goes up, saying, well, we also knew that was going to happen from time to time. So the first one, again, develop a long-term plan. What's another way that we would approach this, Austin?
Yeah, really, you need to think about patience and discipline. And who do I trust? The reality is, if we are long-term investors, we really need to stick to the plan, have patience when those bull markets come, have patience when the bear markets come, not get too overly emotional about our wins or our losses, but realize, again, this is all part of the plan. But then as we're thinking about that, we need to be disciplined in who we're listening to. If we know that there are certain people on YouTube, I realize that it's kind of ironic we're talking to you on YouTube, but there's a lot of personalities out there that will try to sell you on this is the next strategy or this is the next way to do it. There's plenty of people on social media that are not investment professionals that are giving advice that should not be adhered to. So we would say, if those are going to be distractions for you, if those are going to pull you in a poor direction, turn it off. Turn off social media. We realize it's hard, but it's a really important thing to be disciplined and not listen to those voices that are going to heighten those biases that are already emotionally there. What are some other things that we can do, Spencer?
Well, we always come back to diversifying the portfolio. So one of the things that gets our emotions engaged is if we get out over our skis with an investment. So even if we've worked at a company for many, many years and we have a high level of confidence that that company is going to do great in the years to come, we want to have that as a small part of the plan. So probably not more than 5 or 10%, of an overall portfolio if we can make that happen. Now, sometimes we've got some stock options that have to be treated in particular ways within a context of the plan, and we need to hold those for a few years. But overall, if we can, we want to make sure that we diversify well, because that can also reduce the anxiety, reduce the emotions that we have as we implement the plan. So how would you wrap this up?
Yeah, the last thing that I would say is seek professional advice. We are fiduciaries. We have to take our clients' best interests into consideration in everything that we do. And the beautiful thing, Spencer, is I'm not emotional about our clients' money in the same way that I'm emotional about my own money. And so we really say, seek the advice of a professional. Find a fiduciary. Find someone that is making decisions based on your financial circumstances, based on your goals, based on your desires, and not the interest of the person that's giving the advice. And so if you're a client of ours, feel free to talk to us about some of these biases. If you're not, check the link in the description below to reach out and schedule an appointment with us. We would love to have this conversation with you. And with that, we hope you have a good time. We hope you enjoyed this video about behavioral finance, and we'll see you next time. If you like these financial planning videos, please share with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.